Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning, folks. Welcome to the U.S. Markets Wrap with me, Ryan Huang. And looking at what we have on the screen, we have yet another volatile session. And the S&P 500 emerging slightly higher as the market awaits clarity from President Donald Trump regarding his tariff policy rollout. So looking at the broad market index, we've got the S&P 500 adding 0.4% to close at 5,633. The Nasdaq Composite gained 0.9%, ending at 17,450. So a rally in the world's largest tech companies helped to lift stocks on that front, shaking off some of the weak economic readings. And on the Dow Jones Industrial Average, we've got it slightly underwater, 0.03% to 41,990. And to help us navigate what's happening in the markets, we've got some help from Alex Morris. He is the CEO at FM Investments. Alex, thanks for joining us on the show. How are you doing today?
I'm doing well, Ryan. Thanks for having me back.
Yeah, interesting times as we count down towards Liberation Day, and markets have been waiting for this moment and the clarity we hope to get from more details around tariffs. So on that front, already you've seen markets moving, and notably, I think gold prices have hit a new record high. Walk us through what you're seeing on the market action.
I think gold is a good place to start. It is a traditional hedge against inflation, and most of the price action you see today is really retail investors rushing into looking for a haven asset. And all of the uncertainty, right, just listening to the global brands that are being mispronounced, but everyone is going to get very good at pronouncing the words inflation and stagflation very soon. And if you don't get that, then we have to talk about words like recession. And it's all kind of coming to a head. We're going to hear tomorrow, apparently, what we should expect from tariffs. But we know in anticipation, all of the signs are there that prices are going up. Inflation is ticking up as folks are buying and hoarding ahead of the results. And then once they're there, if there are 25% tariffs across the board, across all countries, and there is a retaliatory effect, there's really no scenario where net growth to the U.S. is positive for the next few years. And investors are going to take a while to digest what that really means for asset valuations.
All right, just taking a step back to look at the gold prices that have been playing out in the past few years. Year on year, we are looking at 36% gain. Year to date, 18.5% gain. And on the month, it is up 7.6%. And it's not just gold. We are seeing commodities also pushing up higher, like copper prices. So what's the expectations of how gold will perform this year when you look at how in the past few years it has actually outperformed equities on some fronts?
Gold has been a great performer, which is kind of strange, right? We usually see gold as keeping pace with inflation and some modest return. So the fact that it's had such a stellar return in general makes us worried about overall economic sentiment. I think this year you're going to see it continue to perform well. I don't know that it has another 18% into it this year. Probably has a little bit less. But I do think you're going to find many of those haven assets, the things that actually create inflation, are going to start to go up and tick up further this year as folks get worried about the cost of getting those goods globally at 25 or 30% more is really starting to take hold. And if those tariffs do take place and are enacted immediately, you're going to see a sudden step up in commodity prices across the globe.
Okay, talking about havens, the US dollar typically seen as a safe haven currency to some extent. Where's it going from here?
I think the general consensus of the market is the dollar's going down some, but it's proven resilient. We really don't know how to digest very large, sudden, across-the-board tariffs. So there's really no playbook for that one. I think the dollar, though, this administration is pushing, whether they say it or not, a strong dollar policy. And as a result, although the dollar definitely has some downside to it, I don't think it's that dramatic versus staying long dollar, given how much you're going to see global assets flow into U.S. treasuries, which will ultimately support the dollar by keeping rates stable.
All right, so you've got a lot playing out in the coming days, coming months, and of course all around tariffs. So we've got potentially inflation that investors and consumers have to guard against. What's the playbook here? What are some instruments worth looking at more closely?
You and I have talked a lot about the short end of the curve. We still like low duration U.S. treasuries, lower duration U.S. investment grade debt. We increasingly like very short duration tips as an effort to have a hedge against inflation, but not pick up all that duration that traditionally bogs down tips investors when rates do start to move. We don't mind some equity valuations. Some of the Mag 7 names are probably about as cheap now as you're going to see them for a long time. But we appreciate this is that moment where bonds remind you as to why they're playing a big part of your portfolio. And we think investors are pretty smart to stay in bond land for the next little while.
Already mentioned tips, so that is Treasury inflation-protected securities. What sort of durations are you opting for on that front?
In the tips curve, we want anything below 1 year. We don't want to take undue risk. We don't want rate policy to be the impact here. We just want to buy a hedge against CPI, pure inflation numbers, and you can do that by buying the shortest duration, soonest to mature tips products, which have historically been hard to find. We just launched one, and we know others will follow.
All right. And on the equities front, we've got AI playing out in terms of the potential applications, monetization, maybe even boosted productivity. So what's the playbook here? Are you still backing the Mag 7 on the front?
For AI plays, we still think that makes a lot of sense. It's just hard to run these large language models without many of NVIDIA's products. And the world is being reminded of that. We had the DeepSeek sort of rethink 4 months ago, but it seems that the use of ChatGPT hasn't gone down. And we still think that is going to be a demonstrative thing. We also think that much of the political policy is being based around AI playing a much larger role in productivity as an offset to potential inflationary forces. So we're hopeful that does play out. We think it makes sense to stay involved in the biggest names there for that trend.
Yeah, I've been having fun making manga images of my photos on ChatGPT. So definitely a lot of demand for these products. How about small caps? We've been hearing a lot about the rotation to that space, especially when you think about how you have Donald Trump trying to bring back more of the manufacturing scene back to the U.S., which to some degree could help some of these smaller companies?
I think folks are going to have to be patient in that trade. Small caps haven't fared all that well in the last few weeks, but that's not a problem. I think the long-term case for small caps as a very tariff-heavy environment comes in is very strong. But there's going to be some continued short-term pain as those names sort out who's who in the zoo and who's going to be successful. So there, a broader index probably makes more sense than trying to pick and choose individual winners, given how long it's going to take for this to play out.
All right, talking about things playing out, worth watching what's playing out in the energy space, because we've been hearing about how Donald Trump wants to slap tariffs on people who buy stuff from Venezuela or even stuff from Russia, oil, 50% tariffs on oil importers from Russia. So you're looking at China, possibly India. What's the playbook in the energy space when you look at all these commodities?
There's sort of two homunculi on shoulders here, right? On the one side is the desire to bring energy prices down, which has been a stated goal of the Trump administration. But the other is to use tariffs on energy-producing countries as a penalty to get them to act in line with the administration's accords. It's really hard to reconcile that because energy, in particular oil, is a global commodity, right? We could talk about energy independence for any one nation, but if I can make more money selling that abroad, I'm always going to do that. So I think energy probably has some downside there, mainly because policy is going to really try to push it down. And I think if you are going to see exceptions to tariffs, you're going to see them in AI spaces as well as immediate energy spaces. Less of an issue now. Really could be an issue coming into the winter time when folks have to start heating their homes, and folks in general, the administration won't want to see higher energy prices coming into the autumn. So they've got a little time to play, but not that much time.
All right, lots to watch out for as we head down or count down to its Liberation Day. And we've been in conversation with Alex Morris. He is the CEO at FM Investments. Alex, thanks as always for your time and insights. Great chatting with you.
Thank you.
All right, catch up with you again soon, Alex. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.